I'd now like to invite up our next panel, which is going to look at racial disparities in mortgage lending. I'll invite Professor Manuel Pastor, Richard Green, Amalie Zinn to come have a seat, and then Dean Chris Boone will provide some opening remarks.
Good morning, everybody. My name is Chris Boone. I'm the Dean of the USC Price School of Public Policy. I just want to say a few words of introduction before we move on to the experts in the panel. When we look at the history of housing in the United States, it's deeply intertwined with race and ethnicity. You simply cannot understand housing dynamics without incorporating those important group and social characteristics. And any casual observer in any city, whether it's Los Angeles, Chicago, St. Louis, Washington, D.C., it doesn't take very long to recognize that there are distinct neighborhoods in those cities, and they're often defined by race and ethnicity. By other group characteristics as well. So sometimes it's defined obviously by income, but also even by things like sexuality, and even increasingly by political party. There's lots of reasons for why that happens. It's complicated, like we've used that word many times today, but I think what we would all agree on is that the outcome should not be the result of unfair practices, unfair housing practices, and unfair housing policies. Unfortunately, in the United States, there's a long history of discriminatory practices when it comes to housing. So for instance, when I was here in the mid-1990s, I was doing work on trying to understand different environmental burdens for communities in Los Angeles. In the archives, I'd come across many documents that indicated that there were deed restrictions. So it would basically be a restriction on who the current property owner could sell to, and they would often be defined by race and ethnicity. And even for dog lovers out there, I hate to tell you this, some of the deed restrictions said you could not sell to people with dogs. So dog lovers, even you have been discriminated against. When I did work in Baltimore, where I did work for many years, some of you might be familiar with the scholarship of a legal scholar named Garrett Powers, where he talked about Baltimore-style apartheid. In 1910, this is a result of a Yale-educated black attorney who moved across the color line in Baltimore. He moved east of over into Utah Place, which was then a primarily white neighborhood. And as a result of that, his family was harassed. People threw bricks through his front window, and the city council, fearing a riot, decided to pass the first segregation ordinance in the United States. That was soon after copied by the city of Louisville, and eventually the NAACP, and an interesting partnership with the National Realtors Association, brought suit, which made its way to the Supreme Court, which declared that that was unconstitutional. But after that, of course, there were a variety of other policies that kept discriminatory practices in place. We're all familiar with redlining, Homeowners Loan Corporation, the 1930s. Eventually, during the Civil Rights era, we had the Fair Housing Act, which was passed in 1968. But since then, of course, there are other more subtle forms of discriminatory practices that continue to, I would say, be unfair in terms of thinking about how race and ethnicity continue to be factors in defining how housing practices and priorities are put in place. So history does matter because we still see the legacy and the lasting impacts of these former policies and practices on present-day landscapes. And it's created a number of things that I know that all of us care about, including the lack of intergenerational wealth amongst racial and ethnic minorities. So it still has a powerful impact on the way that we think about how do we provide housing in fair and in just ways. All right, so with that, over to the panel.
Hi, everyone. Thank you for having me. I'm very grateful to be on a panel with such esteemed panelists. My name is Amalie Zinn. I'm a doctoral research assistant at NDSC, and I'm going to talk a little bit about mortgage access in Los Angeles County. As Cam set up and going through our chapters, we've seen over time that the homeownership rate in Los Angeles is far below the national average. So in 2024, the national homeownership rate was 65%. In Los Angeles, just 46% of households in the county own their homes. So that's a real strong rate gap. And we've also seen really persistent racial and ethnic disparities in the homeownership rates in LA that have persisted over time for decades. So this year in SOLACHAN, we wanted to look into one key factor underlying homeownership and homeownership rates in Los Angeles, which is access to mortgage credit. So I'll walk through some of the recent trends and focus on neighborhood level differences today, but also encourage you all to go through the report. There are There's a lot more data than I can share in just a few minutes. And there's also a lot of maps that you can click into and look at your own neighborhood over time, which I think is a real advent of what we've produced at NDSC. So looking in recent years, we've seen really low purchase mortgage demand in LA. Since 2021, purchase mortgage demand in the county has dropped by 41%. Nationwide, purchase mortgage demand over this period dropped by 31%. So certainly high mortgage rates are an issue that are impeding people from entering the housing market on the ownership side, but also the cost burdens in LA are extremely high. In 2025, we saw fewer purchase mortgage applications submitted than in any other year in our data. We look back to 2007. So for context, in 2007, prior to the Great Recession and the fallout, there were about 125,000 mortgage applications submitted in the county. In 2025, fewer than 65,000 mortgage applications were submitted in the county. This is lower than in the immediate aftermath of the Great Recession. So we're really seeing that folks are not entering the housing market at the same clip as they did in the past. We've also seen over time that denial rates on purchase mortgage loans have dropped, though the denial rate in LA remains higher than the nationwide denial rate. Still, we continue to observe really persistent racial disparities in denial rates, and I'll talk about that more at a neighborhood level. But for context, in 2025, in Los Angeles County, 12% of mortgages were denied. Among Black applicants, 19% were denied, 15% of Hispanic applicants were denied. Meanwhile, 10 and 9% of white and Asian applicants were denied. So we do observe these racial disparities over time. We also observe real issues with missing race and ethnicity data that limits our insights into these issues further. In 2025, more than 1/3 of purchase mortgage applications had no attached race or ethnicity data. And I'll talk about this at a neighborhood level as well. And then in today's high interest rate environment, we see really low demand for refinances. However, over time, people that have taken advantage of refinancing and the opportunity to lower their monthly mortgage payments and reduce their rates have consistently been disproportionately likely to be higher income borrowers and white borrowers. So these are the folks that are taking advantage or took advantage of low rates in 2020 and 2021. We did not see the same uptick in refinancing among Black and Hispanic borrowers in particular. So looking at some neighborhood level trends, we've seen a change in the geography of Black mortgage applicants over time. So from 2007 to 2025, we've seen a drop in the share of mortgage applicants identifying as Black from about 6.4% of applicants in 2007 to just 3.6% of applicants in 2025. But we've also seen that in historically Black neighborhoods, for example, Inglewood, Ladera Heights, Baldwin Hills, and Crenshaw, the share of mortgage demand that can be attributed to Black applicants has declined pretty substantially. And some of this reflects rising home prices as well as increased competition. One example here that I think is quite telling is that, in Baldwin Hills and Crenshaw, in 2007, more than half, 52% of applicants were Black. In 2025, just 16% of applicants in Baldwin Hills and Crenshaw were Black. Meanwhile, in the same area in 2007, 17% of mortgage applicants in the area were white. In 2025, 30% of mortgage applicants in this area were white. So we're seeing some folks getting pushed out from the opportunity to access housing in historically Black neighborhoods. However, there's also a lot of missing data, as I mentioned, that's really limiting our insights into what's going on in many neighborhoods, especially neighborhoods that are historically neighborhoods of color. You can see that essentially this entire map has darkened. So basically everywhere in LA, we have more limited insight into who's applying for mortgages. But in some neighborhoods of color, for example, in historic South Central, the share of applicants for whom we cannot observe race and ethnicity data increased from just 7% of applicants in 2007 to 44% of applicants in 2025. We've also seen kind of a similar change in other neighborhoods like East Los Angeles, which tends to be a predominantly Hispanic neighborhood. We do see that there are neighborhood level disparities in purchase mortgage denial rates. So overall, the denial rate in the county was 12% in 2025, but in some neighborhoods, especially neighborhoods that are predominantly Hispanic and Black, like Rancho Dominguez, we see far higher mortgage denial rates. So there's an opportunity for place-based lending products that could kind of lend a hand to neighborhoods that have been disadvantaged in terms of their ability to access mortgage credit. However, place-based is not enough here. Even within neighborhoods, we still observe racial disparities in denial rates over time. For example, in Hawthorne, the overall denial rate was higher than the countywide average. It was 17%, but 50% of Black applicants in Hawthorne were denied in 2025. And we observe this across the county. And again, these maps are available and you can click into them and scroll across the county. We also observe similar within neighborhood denial rate disparities for Hispanic and Latino applicants, though they tend to be less sharp. But a bit harder to tell for Latino applicants because they're very underrepresented in the mortgage demand side. So only 22% of applicants in 2025 identified as Hispanic or Latino. However, because of all the missing data we have, especially in heavily Hispanic and Latino neighborhoods, it's really hard to tell if these denial rate disparities are actually less sharp or if we're just not able to observe them to the same degree. So I'm looking forward to talking about that with the panel. Thank you.
Good morning. My name is Richard Green. I am director of the USC Lusk Center for Real Estate, and it's a thrill for me that neighborhood data for social change became part of our ambit about 4 years ago. Was it? Caroline doesn't want to hear what I have to say. 4 years ago. Okay. And I also am just going to mention right now that even though my job satisfaction as an academic has been very, very high over my 36 years, I consider my proudest professional achievement to have worked for 1 year as senior advisor on housing finance to HUD Secretary Julian Castro and the Obama administration. And a lot of what I worked on involved the issues that we're going to talk about today. To my right, we have Dean Chris Boone of the Price School of Public Policy. Beyond being an excellent navigator of difficult times at universities, we have observed this for Chris for about 18 months now. I guess longer than that, isn't it? 20, something like that. Yeah. A really distinguished scholar on sustainability issues and environmental justice issues. And so with that background, he already showed he has a lot to add. It's hard to believe someone as mature, second-year PhD student, Amalie Zinn. Amalie came to us from the Urban Institute, and before that, the University of Wisconsin, which is a school I have a particularly warm spot in my heart for. And then next to Amalie, somebody I'll call a stalwart of USC and Los Angeles and the state of California. He has been contributing important stuff on the sort of issues we're going to talk about today for, I'm not going to say exactly how long, but Manuel Pastor. So thank you to everybody for being here today. Now, we started with Amalie's. Is anybody surprised, by the way, from anything that Amalie told us just now? Was anyone shocked out there? Okay, so let's talk about why we're not shocked. What has led us to this point? I mean, in 2025, see, I don't want time to go by any faster than it is. 2026, to see the sorts of outcomes that we're seeing right now it should be shocking, but it's not shocking. And I think Manuel can fill us a little bit on sort of historical context of why we are where we are right now.
Very well, glad to be here. And I know everyone has just been thrilled with the data today. This has basically been a nerd fest for people who love data. This is a little bit like Coachella. So
better.
Yeah, it's much
better.
And I always like to let people know, my friends here know, that if while I'm talking my voice gets a little ragged, you might think it's because I've been screaming about redlining for years. That's part of it. But I also have a voice condition that's called spasmodic dysphonia, spasms around the voice box. It's a condition that will cause my voice to break or sound tired. It's been made famous because it's the condition that Robert Kennedy Jr. has. You know, his voice is very scratchy. So if mine was not treated, I would sound like Robert Kennedy Jr. I would not be as delusional as Robert Kennedy Jr. because I think that's a standard to which no one can really rise. So the themes I'd like to lift up is the notion of path dependence and then path breaking. The path dependence is what we're seeing in the data. The persistent disparities in lending, and this does build on a history of redlining, and then a history of accumulated disadvantage. Because without those assets, people are not as able to start businesses, not as able to get the money that's a cushion to be able to go to college, not as able to succeed in labor markets as well. And then, as Chris and I both know from our work in environmental justice, wind up living in communities that have higher hazard conditions, lower rates of health, et cetera. So we see a lot of accumulated disadvantage that's rippling through not just housing markets, but labor markets, health, and general living conditions. There are some things, though, that I think are a little bit interesting to pay attention to. The point that Amalie made about the shifting character of who is buying in historically Black neighborhoods like Baldwin Hills, Crenshaw, and the gentrification that's taking place. And by the way, that connects to that great work around NOAA, naturally occurring affordable housing. I love that expression. And I love core NOAA. But, one of the things, if you think about what seems to be going on in that data, and some years ago, I became a landlord myself. I am not a gigantic capitalist. We bought a property so that my daughter, who's a social worker, could afford the rent, meaning nothing. Damn her. But one of the things that we've noticed, it's not just with her because it's a duplex, is that once you get a tenant in, you try to keep that tenant with lower rents. And that's a little bit of what's going on with what we see, a kind of path dependence. And I'm very concerned that as you begin to see gentrification, that landlords will be tempted to do everything they can to take that naturally occurring affordable housing and make it housing that's not so affordable and bring in different tenants. So a lot of what we're looking at, Richard, is path dependence. I think a lot of what this audience wants to also talk about is what is path breaking? What could actually get us out of the conundrum that we're in right now? And with that, I will tease you so you can ask me another question I prompted you to ask.
Which I will in a minute, but I want to go back to the Nerd Fest a little bit and just talk about the nature of the data that we're looking at when we do this work at the moment. And Amalie, you mentioned this change that's happened in terms of the number of people who in what's called the Home Mortgage Disclosure Act data just don't answer as to race and ethnicity. And what does that mean in terms of the inferences we're trying to draw here?
I think it's a big issue, and we've seen it to be a big issue nationwide. In 2018, there was a change that took a while to go into effect. So it went into effect in 2018 in terms of how mortgage data, how race and ethnicity data was collected in HMDA. And one thing is that it offered people kind of more categories. So there was some idea that maybe people stopped reporting their race and ethnicity, especially when people do a mortgage application online. It's self-reported data, whereas before, if you would go into a loan office to a bank to get a loan and speak to a loan officer, they would report your race as what they observed. So if you're doing your application online, it's up to you to report it. There was some idea that this big uptick in missing data in HMDA could be attributed to this change. However, folks do seem to like, from what we can observe, these extended categories. People do report more information. For example, Asian borrowers are pretty apt to report, at least nationally, their nationality and where they come from. So it doesn't necessarily seem like that those additional categories are the core issue, but we have pretty limited insight, at least in LA so far, into who these missing race and ethnicity borrowers are. So I showed some of the neighborhood level. Nationally, there was research done in 2021 that found that on the whole, borrowers with missing race and ethnicity data tended to look like borrowers on average. They actually had slightly higher incomes, but otherwise there didn't seem to be kind of, they really look like borrowers of color who might be less apt to report their race or ethnicity. However, in LA, given how much missing data there is, that might be a different story. And I think that's definitely an area that we could do more on, looking at the incomes of these borrowers, their debts, what types of mortgages they're applying for, et cetera, and in what neighborhoods, and we can draw some better inferences there. But on the whole, it just really, I would say, limits our insights into what these racial disparities are and where they're occurring, especially given the high rates of missingness in neighborhoods of color. And so that's pretty limited in terms of what we can say about, are we making progress in terms of declines in denial rates by race and ethnicity, for example, or are we just seeing we're not actually observing the majority of these borrowers?
If I could add to that, I do think that one thing that's probably particular in LA County, and it's interesting that the rates are higher in South LA, which is actually 2/3 Latino. And if you look at the public use microdata areas. I know this audience knows what that is. But those are basically broad census neighborhoods. Of the 58 or so that are in the county, the 3 of the top 5 that have the largest share of undocumented Latino adults are in South LA. So you've got a large mixed status and undocumented population that does apply for loans, but is perhaps, if something is voluntary, not going to put down the data that they don't really have to volunteer to be able to get the loan. So I think one of the things that might be very different than the national data is this pattern that you're observing in LA.
So until now, you thought Puma was either a cat or a brand of shoe, but it's also a very important geographical distinction in the census. So thank you for elucidating that. I wanted to turn it over to Chris. I want to refer to some of your environmental justice work, and with a very specific lens on housing. So we do focus on, are people homeowners or not? And we rightly make that a big deal. But there are also people who get to be homeowners in places where houses appreciate and places where they don't. And I'm assuming your environmental justice work has looked at that issue at least tangentially. I mean, is this something that we need to worry about as we're thinking about the kind of houses that we're giving people the opportunity to live in?
Yeah, so I'm going to go back to Baltimore, where I've done a lot of work. And one of the things that we found in our research is that houses will be passed down from generation to generation, but because of the redlining laws, I assume everyone here knows about redlining, but it led to disinvestment, is that a couple of things happen. Typically, the home values wouldn't appreciate, obviously, at the same level as other neighborhoods, so you wouldn't have that intergenerational wealth transfer. But also because of the deed restrictions that were in place still, right, until the Fair Housing Act of 1968, it meant that the opportunities for people where they could live were restricted. So in some of the neighborhoods in Baltimore and West and East Baltimore, those dwellings became more and more crowded, and as it became more crowded, then obviously it became more difficult to maintain, and that would further drive down the value of those properties. So it had a sort of a vicious cycle would take place as a result of the deed restrictions, the redlining and other mechanisms that were in place that basically reduced the amount of choice that was possible for Black Baltimoreans and where they could decide to live.
And what about just beyond the institutional phenomenon of redlining? What about just proximity to environmental hazards? I mean, presumably, if you're near an environmental hazard, your opportunities for, beyond all the other issues, see, I'm an economist, so I only think about money. Your opportunity for appreciation is not going to be as good.
This one is interesting, especially in the case of Baltimore, because in Baltimore, if you look at where most of the toxic release inventory sites are today, they're primarily in white neighborhoods, not in Black neighborhoods. And there's an interesting historical reason for it. And that is that historically, if you lived close to a factory, that was considered to be an amenity. So for many Black Baltimoreans, they would have to take streetcar, take long transportation to get to work in order to, if they could get jobs at these factories. But we still see, this is why history is important, because we still see a legacy of that in the pattern of where we see industry and toxic facilities today. Now, Baltimore is unusual because in a place like Los Angeles, there's long been an association between industrial sites, toxic facilities, and where Hispanic and Black communities are. So it's that's the more classic environmental justice case. But there are, Cleveland, I think, and Detroit have some similar patterns to Baltimore in that respect too. But you're right. Historically, it would mean that having a big belching smokestack in your neighborhood doesn't generally drive up housing values.
I would imagine not. So Amalie, I want to, and then I'm going to get to Manuel on how we're going to change things. But there are going to be skeptics who say, "Oh, yeah, you're not controlling for stuff, and yeah, it's about income, and it's about credit score, and it's not really about race and ethnicity." Because, one of the problems with economics, I will say, as a card-carrying economist, is economics gets the null hypothesis wrong. Is the null hypothesis for economists is discrimination is irrational, so therefore it can't exist, and you need to prove that it does exist. Whereas the correct null hypothesis, in my view, having grown up in the United States, is the null hypothesis is that there is discrimination. You need to prove to me that it doesn't exist. But that's it. There are skeptics out there and say you can't really draw the inferences that you drew. So how would you respond to that?
It's a great question. I think it's very important. In terms of what we can get at using the Home Mortgage Disclosure Act data, we can look at income. And we did look at denial rates by race and ethnicity across the income distribution. We see that overall, people with higher incomes are denied at lower rates than their lower income counterparts, which makes sense, as debt to income ratios are a very important factor in mortgage underwriting. However, even in the highest income bucket, people of color, Black and Hispanic people are still denied at a higher clip than their white counterparts. So just on the income hypothesis, I think we can kind of strike that out as kind of, okay, well, all of this can be attributed to income. Certainly when it comes to credit scores, we don't have access to and publicly available Home Mortgage Disclosure Act data, but goes into mortgage underwriting. Some of that can definitely reduce racial disparities in mortgage denial rates. But I think something that we've talked about a lot is that one's credit score isn't necessarily race neutral in reality, even though it might not be actually, oh, we're looking at their race, but someone's credit score really reflects their financial opportunities in mainstream financial markets, which are heavily racialized and reflects longstanding racial wealth gaps and opportunities. So one's ability to build credit relies on their ability to get a credit card, which is that's intergenerational. There's been recent research that's looked at people who are able to become authorized users on their parents' credit cards. Those people whose parents were able to build up credit over generations. They had a mortgage. They were able to have a profile. So all of this reflects kind of highly racialized systems. And mortgage underwriting on the whole is kind of built, I would say, on a bedrock of structural racism. There was, of course, codified and legal and institutional racism embedded in the mortgage underwriting process legally. And some of that has been taken out. So obviously discrimination is technically illegal, but the factors that we use to decide whether one is creditworthy and whether one is likely to be able to repay their mortgage are related to other issues of discrimination.
So before I turn it over to Manuel, I want to pick up on that because I'm going to make a statement that may actually surprise the audience. Is debt to income ratio is an unreliable predictor of mortgage default and reflects some of the phenomena that Amalie is talking about. And this is something I worked on when I was in the Obama administration. And we actually got some changes done. And then on January 21st, 2017, those changes went away. And on January 21st, 2021, they came back. And on January 21st, 2025, they went away again. But the problem is debt to income is a badly measured variable, okay? And here's why. Now, as it happens, credit score has its issues, but it's a much stronger predictor of actually mortgage outcomes than debt to income ratio is. And down payment is a very strong predictor of mortgage outcomes. So those are, I would make changes, but they're legit. But DTI barely has an impact on the ability to predict default. And here's the reason why. Number one is lenders discount what I'll call 1099 income. Just think of the world. You have W-2 income and 1099 income. Lenders consider 1099 income less reliable than W-2 income. So they will, in your underwriting, just say, yeah, we're going to count 50% of that, not the whole thing. Okay? Now, it turns out, this is part of what I studied, if you have 2 years of kind of solid 1099 income, you're pretty much as reliable as a W-2 person. Okay? So just think about what that does to your ratio, right? Is if you're going to cut that income in half, your ratio is going to go up and you're going to be more likely to be denied. Second thing is what's called the thin file problem. Is suppose you have a married couple and one has a strong credit history and the other doesn't have bad credit. They just have what are called thin files. So they grew up in a household without credit cards, for instance. Okay, the way FICO defaults is if you have a thin file, you get a low credit score. The assumption is if we don't know, you're bad credit. The fact is, just think about someone who has paid their rent, paid their Verizon bill or AT&T bill or T-Mobile bill, their cable, et cetera, on time, month after month after month, using cash. Are they an unreliable credit risk? Probably not. Okay, here's what a lender will say to that couple. You know what? We're going to take the lower of your two credit scores. So only you with the 740 FICO, apply on your own. Don't make it a joint application. What does that do to the household income? It cuts the income. What happens to the DTI? It goes up. Whoops, that DTI is too high. We're going to reject you. Okay. And so I had a saying in Washington. I was trying to moneyball this. Didn't work particularly well. But my saying was statistics, not heuristics. Is there ways we can model this in a way that we have a much more inclusive mortgage system, yet is every bit as safe? In fact, I would argue safer. We don't want people to default. We want people to only have mortgages that they can actually afford. So making that little change, which sounds very nerdy and very kind of surprising, I think could go a long way toward making things better. Again, nothing is panacea, but with that, let me turn it over to Manuel on his thoughts about the sort of changes we need to be making.
I'll get to the changes, but I do want to stick with this thing for just a minute, because I think it's important to, for example, in the work we've done on environmental justice in Southern California, then if you do meta-studies looking across the country, Baltimore is an exception, but generally race is a more significant predictor than income about whether or not you're going to be living near a hazard, because it has a lot to do with power and the ability to change a system to not get siting. When we're thinking about looking at people's income and whether or not they can make it over the hurdle to get a mortgage, it's important to realize that for Black and Latino, middle income, even higher income folks, they generally have less wealth because of the history of asset stripping from their parents and grandparents, etc. And they often are supporting more people with their family income than a typical white applicant who might be bringing wealth in. So race matters significantly, and the people who have a null saying it doesn't are off. And so I'm glad you brought that up, Richard. Now, how do we move from path dependence to path breaking? And here what I'd like to do is talk a little bit about how this fits in. Anybody here ever written a book? A couple of you maybe?
Written a book?
Written a book? Some of you might have read a book, but for any of you who've written a book, you know that one of the most exciting things is the day that it arrives, and it actually has kind of a new book smell to it. Fits right out of the printer, and you're very excited, and you open it up, and you immediately realize that everything in that book you could have said in 3 sentences or 3 words. And there's a book we wrote some years ago.
You should read my books then.
I know mine are 2-word books. I don't know about yours, Richard. But one of the books we wrote some years ago talking about how change happens at a regional level, actually, we realized afterwards boiled down to 3 words: data, deliberation, and destiny. That is that you needed to have data to ground people in what the problem was. You needed to have deliberation, bringing people together to talk about it so they could develop a common understanding. But you also importantly needed a sense of common destiny. And when we live in a Southern California that is so atomized, where people feel like, boy, I'm glad my neighborhood's doing okay. I'm not so worried about your neighborhood because it's not mine. When we feel like, as an older generation, man, I'm glad my housing values are going up. I'm not so concerned that young people can no longer afford to buy in. I'm glad that that mortgage system is working for me. I'm not so concerned that it's not working for communities of color. When we don't have a sense of common destiny, that's when these problems really take root and persist. I was thinking and talking with y'all before about a parallel, which is that I'm so glad this is the second year. I'm sure that next year you will be doing this in the convention center. People will be so excited about this report. But we, for about the last 15, 17 years, have been working with the California Community Foundation on a Council on Immigrant Inclusion and releasing each year for about the last 5 years. We took a hiatus last year. We'll do it again this year. A State of Immigrant California. And what that did was ground people in data like 1/5 of Los Angeles is either undocumented themselves or living in a mixed status family. So if they're terrorized right now, all of us are going to suffer. That about 1/3 of our frontline construction workers are undocumented. There's no way we're recovering from the fires unless we get that workforce back in gear. That when you look at who is doing elder care and child care, that's largely immigrant, largely female. And if they feel frightened to come to work, the whole sandwich generation that's professionals, that's worried about their parents and their children and the care system are not going to be able to contribute as well. So how do we use these reports to ground people in data, create deliberation so that we have a common understanding that we need to address this problem, and then a sense of shared destiny where we begin to realize that just like a system of over-incarceration throws away talent, just like a system of underinvestment in public education shortchanges our workers for the future. Having a persistent housing crisis and inequitable lending markets is something that is hurting not just the immediate victims, but all of us as part of Los Angeles County.
I just want to add one more point, which again is the economist in me, is it also means there's business that is not being done, that should be done. There is profitable business that's going undone because of these sort of institutional phenomena, or just the fact that people are unaware of the possibility that there are good loans to be made that they are not making right now. So you can't motivate people through moral exhortation. Money sometimes actually works as a way.
You know, money does work, and I always have that. You're lucky enough to have an endowed chair. I am too at USC, and I once asked the guy who endowed it, he actually put quite a bit of money in. And I don't know what this happened for you, but they actually give you a chair. So my office has like a literal chair. It's kind of cool. But I once asked the guy who endowed this chair, like, how did you get so rich? And he said, well, I treated my customers right. I treated my workers right. I treated my suppliers right. And it worked out. And that kind of ethos, that's the economic ethos that really makes sense. If we treat each other right, it might just work out. When we shortchange each other in labor markets, in mortgage markets, and where environmental hazards and environmental amenities are, it's not going to work out for most of us.
You just described Saul Price, right? Who is the namesake of the Price School. And his son gave the gift to endow the school in his father's name. And he would often talk about the fact that his father didn't get rich and then do philanthropy. He built a philanthropic model into the business because he knew that was a good business case to make. So yes, it can be done. We have examples.
So yeah, if you can forgive a really quick story about him, you know, he desegregated lunch counters in Dallas because Dallas Jim Crow laws forbade mixed rate people to sit down in restaurants. And so what he did is he set up a countertop restaurant in his store. No chairs. He had a stair to eat those. What do they cost? $1.50 still at Costco? Hot dogs. It was the way that he figured out how to get around the law and actually integrate lunch counters in Dallas. So, and he did some business doing that too.
Yeah, and also in the Navajo Nation, he hired Navajo workers for the Navajo Price Club, which eventually became the Costco. Yeah, so you can do business in a way that makes business sense, but also embeds in it those principles of fairness and justice that actually make those businesses profitable. It can be done. It's path breaking.
Okay, so we have 1 minute left. So between the two of you, could you just talk for 45 seconds about heirs property, just what it is and why we should think about it?
Property is property that's inherited without formal legal documentation. So when property is passed from one generation to the next without a legally binding will or estate plan, the title is unclear to that property, and it presents a lot of challenges for accessing the full benefits of housing. You don't get all the tax benefits of housing. You're vulnerable to forced sales. And Manuel and I have been trying to focus on this issue in Altadena in Los Angeles in the aftermath of the Eaton fire, where there's a lot of multi-generational and longstanding Black homeownership, but not necessarily the kind of legal pathways and an opportunity to transfer that housing across generations. And so thinking about mortgage access over time of, are folks going to be able to get loans to rebuild or buy new housing in Altadena? I think this is a real issue. We've seen very few mortgage applicants in Altadena in 2025 that were Black people. Some of that can be attributed to the fires. People are not, applying for mortgages at the same clip in Altadena, but it's definitely a big issue.
And I would just add that it is a big issue, and it's a particularly important issue in California because of Prop 13. Because if people did not legally pass title, the assessments that they're working with are from often pre-1975. And as a result, the penalties that they will pay are much more significant than would occur in other disasters in places around the United States. One last thing. It's rather remarkable to have such a talented graduate student holding her own with these old-ass professors up here. So,
yep. One of the many benefits of teaching at USC. So, I know, Manuel, you actually have to run to another meeting. Let's just give her one more round of applause to Chris Boone, Amalie Zinn, Manuel Pastor. Thank you all.